A house is the biggest thing you will ever buy, and somehow it is also the thing you get taxed on from every direction. Stamp duty when you buy it, council tax every single month you live in it, capital gains tax if you sell the wrong one, extra charges if you accidentally own two homes at the same time. And here is what nobody hands you a leaflet about. At almost every one of those points there is a legal way to pay less, claim money back, or have the government top you up, and the people who know them quietly save thousands while everyone else just pays the sticker price. These are 10 of them. You do not need to be a landlord or a property tycoon. You just need to know the door is there. Stamp duty rules here mainly mean England and Northern Ireland because Scotland and Wales have their own versions. But the point is the same. If you do not know the rule exists, you usually just pay. Number 10. The stamp duty. You are not supposed to pay. You are buying your first home. You have saved for years, and now, right at the finish line, the government wants a slice called stamp duty. What a lot of first-time buyers never realize is that they get a special relief. As a first-time buyer, you pay no stamp duty at all on the first £300,000 of the price, and then 5% on the bit above that, up to £500,000. So if you buy your first home for £350,000, you are not paying stamp duty on the whole thing. You are only paying 5% on the 50 grand above the first-time buyer threshold. That is £2,500. Not some terrifying number someone invented in a group chat. But here is the catch. Go above £500,000, and the first-time buyer relief disappears. You drop back onto the normal rates, so the price matters more than people realize. On a typical first flat, this can be thousands of pounds you simply do not owe. It is like queuing all day for a ticket and then being waved through a side gate for free, but only if you are standing at the right entrance. Make sure your solicitor has actually applied the first-time buyer rate, because if they slip and charge you the standard rate, you have been overcharged, and you can claim it back. Number 9. The council tax band nobody checks. Every month, the council tax bill lands, and most people just accept it. They moan about it, set up the direct debit, and move on. But your council tax band might be wrong. In England, council tax bands are still based on what homes were thought to be worth back in 1991. Not today, not when you bought it. 1991. Which means mistakes, rushed valuations, and weird comparisons can sit there for decades, quietly costing people money. If your house is in a higher band than near identical neighbors, you can challenge it. Get it lowered and your bill drops going forward, and in some cases, they refund the overpayment all the way back to when you moved in. That can be years of money in one lump. It is like discovering the gym has been charging you the premium tier by mistake since the day you joined. Check your band against similar neighbors on the official valuation site before you challenge, because a band can in rare cases go up. But if the evidence is strong, this is one of the easiest overpayments to miss. Number 8. The council tax discounts. They never advertise. You get a council tax bill and assume that is the number. Take it or leave it, but there is a whole shelf of discounts the council will happily let you never claim. Live alone? 25% off if you ask. Full-time student household? Often exempt. Someone in the home qualifies under the severe mental impairment rules. There can be a major reduction. A property empty because someone has died and probate is being sorted. There may be relief for a period. Some empty home and renovation rules depend on the council, so you have to check locally, but that is exactly why people miss them. They assume the bill is fixed. It is not always fixed. It is like a menu of vouchers taped under the table where nobody thinks to look. Ring your council or check their site, tell them your situation, and the ones that apply can often be backdated. Number 7. The wreck that might cut the tax. You buy a proper doer-upper, not needs a lick of paint. I mean no working kitchen, no safe bathroom, serious structural issues, the kind of place where nobody is realistically moving in on completion day. Everyone assumes stamp duty is stamp duty. But in extreme cases, if a property is genuinely not suitable to be used as a dwelling at the point you buy it, it may not be treated as a normal residential home for stamp duty. That can change the tax treatment. This is not a cute renovation hack. A tired house is still a house. A damp house is still a house. A house with an ugly kitchen is still a house. But a genuinely derelict, uninhabitable property can sit in a different category, and people have overpaid by letting it go through as standard residential without anyone asking the question. It is like being charged full price for a car with no engine, then finding out the system may not treat it like a normal car at all. If you bought somewhere properly derelict, get a specialist to check whether the stamp duty was right, because the reclaim window is real, but it does not stay open forever. Number 6. the shop downstairs that cuts your bill. You are buying a property, and part of what you are buying is commercial. Maybe there is a flat with a shop included underneath. Maybe there is a residential unit and a proper business space attached. Maybe the deal includes land, or a building that is not purely residential. Ordinary buyers often see this and think, that sounds complicated. But for stamp duty, it can be a quiet gift. A genuine mixed-use property can be taxed at the mixed-use rates, which are usually lower than residential rates, and it can also avoid some of the brutal extra residential charges. It is like ordering off the cheaper trade menu, because part of your order genuinely belongs on that side of the counter. The key word is genuine. A flat above a shop does not count if you are only buying the flat and the shop belongs to someone else. But if what you are buying actually includes a commercial part, get your solicitor to check whether the mixed-use rate applies before they file the standard one. Because once the return is filed, you are relying on someone noticing the mistake later. Number 5. The surcharge. You can claw back. You are moving house, but the timing is messy. You complete on the new place before your old one is sold. So for a moment, you own 2 homes, and the taxman hits you with the extra stamp duty surcharge. And that surcharge is painful. It can be thousands of pounds on top of a bill that was already painful. What almost nobody explains clearly enough at the time is that this can be refundable. If the new place is replacing your main home, and you sell your old main home within 3 years, you can usually reclaim that surcharge from HMRC. It is like paying a deposit you assumed was gone, then being handed it back once you tidy up the move. But it does not arrive on its own. HMRC does not sit there waiting to surprise you with a refund. You have to claim it. So if you ever pay the higher stamp duty surcharge because you temporarily own 2 homes during a move, put a reminder in your calendar the day you complete. Sell the old home. Claim the surcharge back. Do not let thousands sit there because nobody told you the money was returnable. Number 4. The tax you never pay on your own home. You have owned your house for years. It has gone up nicely in value. You are about to sell, and you start wondering whether capital gains tax is about to come for the profit. For most people, selling their only or main home, the answer is no. That is because of private residence relief. If the home has been your only or main residence while you owned it, the gain is usually free from capital gains tax. All those years of the value climbing, tax-free. It is like a savings account that grew for a decade, and the taxman just nods and lets you walk out with the lot. The trap is when life gets messy. You own 2 homes. You move out and rent the old place. You use part of it only for business. You spend long periods not living there. That is when the relief can stop being simple. And if you have more than 1 home, the main home question can become very expensive. So if you have ever owned 2 properties at the same time, do not wait until the sale completes to think about it. That single detail can be worth a fortune. Number 3. The split that doubles your options. You are selling a property that does have a taxable gain. Maybe an old flat you kept. Maybe a second home. Maybe a buy-to-let. And you are married or in a civil partnership. Most people assume the tax is just calculated on whoever owns it. But transfers between spouses and civil partners are usually tax-free for capital gains tax, which means, with proper planning, you may be able to transfer a share before selling. Now 2 people can use their own tax bands, and possibly their own capital gains allowance, against the gain. That can mean less of the profit is taxed at the higher rate. It is like splitting a restaurant bill, so one person does not get stuck paying the entire thing at the most expensive rate. This has to be done properly, and before the sale completes. And if there is a mortgage, you need advice, because taking on debt can create its own tax issue. But the basic point is simple. If a taxable property sale is coming, speak to an accountant early. Not after exchange, not after completion, early. Number 2. The discount on buying your own council home. You have rented from the council for years, paying every month, living in the same home, building your life there. What a lot of long-term social tenants never fully check is whether they have a legal route to buy that home at a discount. For eligible council tenants, right to buy can knock a significant amount off the price. For some housing association tenants, different schemes may apply, like right to acquire or preserve right to buy. The details matter, and the rules do change. But for people who qualify, this can be one of the biggest property advantages available. Not a tiny refund, not a couple of £100, a real discount on the home you already live in. It is like renting the same car for 20 years and then finding out there may be a route to buy it for less than the sticker price. If you are a long-standing council or housing association tenant, check your eligibility and the current discount. Because some people sit as tenants for decades without ever checking whether ownership was actually closer than they thought. Number 1. The grander government adds to your deposit. You are young, or youngish, and you are trying to scrape together a deposit for your first home. It feels impossible. Rent eats your wages, house prices move faster than your savings, and every month, the goalpost seems to slide further away. Here is the one that genuinely feels too good to be true. Open a lifetime ISA between 18 and 39, and for every £4,000 you put in each year, the government adds £1,000 on top. That is a 25% bonus. Free money toward your first home, as long as you follow the rules. The property has to be within the lifetime ISA limit, currently £450,000. The account has to be open for at least 12 months before you use it, and if you withdraw for the wrong reason, there is a penalty. So do not treat it like a normal savings account. But if buying your first home is genuinely on your horizon, this is one of the clearest boosts available. It is like a shop that puts a quarter of your money back in your pocket at the till every single year, and half the people walking past never even open the door. You do not even need to max it out on day one. Even opening it with a small amount starts the clock. Because the painful version is finding the right house, finally being ready, and then realizing your lifetime ISA has not been open long enough to use. So, which of those did you have absolutely no idea about? Tell me in the comments, especially if you have just realized you overpaid on one. And if you want the third one, the tax traps that quietly cost you the most when you sell, inherit, or rent out a home, hit subscribe so you do not miss it. None of this is dodgy. None of it is hidden. It is just the part of owning a home that only saves you money if somebody actually tells you it is there. Now somebody has.